We've seen, and everybody's documented all this massive amount of gold that has flowed out of London, allegedly into the COMEX vaults. But now we're seeing the same thing in silver, Andy. And boy, that, everybody, all these reasons for gold, but no one was ever really talking about silver. That the amount of silver that's gone into the COMEX vaults has exploded. The amount of deliveries off the COMEX has exploded too. We're now into the month of March. COMEX has already seen about 70 million ounces delivered, maybe all the way up to 100 million as we get, by the time we get to the end of March. The amount of metal flowing into the COMEX vaults is going up every day, sometimes 3-4 million ounces a day. I don't know what's going on here.
Silver is making headlines again, but this time, it's not just about price movements, it's about where the metal is going. CraigHemke, the Sprott Money Weekly Wrap host, highlights a massive flow of gold and silver out of London, with significant amounts reportedly moving into COMEX vaults. While gold has been the primary focus, silver is now experiencing a similar trend, with deliveries and vault inflows reaching unprecedented levels. The surge in silver inventories at COMEX is likely tied to multiple factors, but the timing suggests that traders and institutions are preparing for March contract deliveries. Silver contracts on COMEX, unlike many other futures, offer physical delivery, and when demand spikes for actual metal, inventories must be built up to meet obligations. At the same time, silver's technical positioning on the COMEX May 2025 contract is reaching a critical juncture. The 68.2% retracement zone between $31.72 and $32.82 suggests silver is at a significant support level. Traders also target the $35 level, where a large concentration of call options suggests significant resistance ahead. A similar pattern was seen in March 2020 during the COVID-19 crisis, where logistical issues led to a divergence between COMEX and LBMA silver inventories. Silver demand surged as investors sought physical metal, causing market volatility. While the current situation differs, large inflows into COMEX indicate something significant may be happening. Hemke notes that the rise in physical silver demand suggests tightening global supply, increased investor interest, or strategic reserve accumulation, which could lead to a supply squeeze and higher prices. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
You wonder, the size of the net short position that is shown in the Commitment of Traders reports is around 400 million ounces for the swap dealing banks. And, it makes you wonder, what happens if there are some delivery demands. I mean, look, Andy, you could get up, go make yourself a cocktail, walk around, go outside, walk the dog, all that. And I could talk for over a half hour about the history of all this stuff. But even just go back to 2011. We know from the discussions, and you were at least acquaintances, if not friends, with Bart Chilton and what he shared with everybody right before he passed away about the Bear Stearns short position that JP Morgan took off Bear Stearns' hands in the financial crisis, and how they were under orders to liquidate it, and cover it. They never did because they found they could make money at it. And they ended up short 30, 40,000 contracts, whatever it was, with no physical metal behind it. And they got caught in a short squeeze in 2011. And of course, everybody knows what happens after that. They were saved. Ever since then, they immediately opened a vault. They never had a COMEX vault, but they immediately opened one, rubber stamped to open one. And over the next 7 or 8 years, I have all the records. I tracked it all. The house account at JP Morgan would stop 2,000 contracts of silver here, 3,000 contracts there. And suddenly they had 150, 160, 180 million ounces in this vault that never used to be there. So they've at least built up a position, where if they're forced to deliver it out, and we've seen that here in March, they could. But as a net basis, though, you've got this massive short exposure of these banks with not enough metal to cover it if they were ever called to the carpet. So we'll see. Silver's such a different animal than gold. All this metal flowed out of London, and I'm sure you've been covering the Financial Times report about the 4 to 8 week delivery delay if you want any gold in London. We'll see what happens next in silver. All the silver that's being moved into New York's got to be coming from somewhere. I don't think the float is the same. I'm sure you could probably discuss that as to how much silver is immediately accessible on the LBMA and to the banks there. You remember, we've talked before, and again, at the risk of repeating myself and making it sound like, well, everybody should know this. The Bank of England and the LBMA will come out and say, oh, no worries, man. We've got 8,000 metric tons of gold in London. There's plenty of gold. well, wait a second. Why are there's a 2-month delay to get my hands on some? Well, no, it's not that the gold's not there. The problem is 4,500 tons are the Bank of England's gold. Another 3,400 tons are ETF gold that's custodian there. So that shouldn't be up for sale or up, to be lended or loaned. So really the float in London's maybe 800 tons? Now after the combined 3 years of central bank demand of 3,400 tons? Maybe they just don't have any left. And so then you project that onto silver with 700 million ounces of supply deficit over the last 4 years. We may be about to find out they don't have any silver either. And so all of this is all part of the fun as 2025 continues.
Revaluation has gained renewed interest in light of President Trump's conflicting goals of increased spending and tax cuts. The administration has explored alternative strategies to generate revenue, including creating a sovereign wealth fund. President Trump signed an executive order to establish such a fund, allowing the nation to invest strategically in various assets. This initiative aligns with the administration's broader plan to monetize the asset side of the U.S. balance sheet, U.S. Treasury Secretary Scott Bessent stated. His remarks have sparked discussions about the potential monetization of U.S. gold reserves to bolster national wealth. CraigHemke suggests that the U.S. government's official revaluation of gold would not necessarily trigger an immediate financial collapse, but would serve as a powerful signal to global markets that the financial system's rules are shifting. History has demonstrated that when systemic threats arise, regulators are willing to change the rules, just as they did with the Hunt brothers in 1980. The Hunts had leveraged oil and gas leases, real estate, coal holdings, antiques, and even luxury assets such as a Mercedes and a Rolex to finance their silver investments. However, the Seattle Times reported that regulatory intervention led to their downfall. A $180 million judgment against them ultimately pushed the Hunts into bankruptcy. From their once vast fortune, Bunker Hunt was left with only a few $1,000,000, a stable of racehorses, and a $90 million tax bill to be repaid over 15 years. Let's get back to the interview.
You'd have to come up with $2 trillion, you'd have to, know that you've actually got 8,133 tons, which itself is overstated probably by 10% because so much of it is coin melt bars at 90% purity. So you have to re-refine that for that little error factor. But let's just take them let's just say there is 8,100 tons. If you marked it to market, that's $750 billion. If you marked it to $10,000 an ounce, now you got 2 some odd trillion. Now, again, that doesn't mean, look, we've never been through this. You and I, anybody listening. I mean, the gold price has been pegged where it's been pegged for 70, 80 years. So if U.S. comes out and says, yeah, we're going to, as an accounting procedure, we're going to start carrying this stuff at $10,000 an ounce. That does not, at least I don't think so. That does not mean the next day gold on COMEX is trading at $10,000 an ounce. It's just an accounting procedure. Gives them some leeway to issue these bonds without blowing up, another $2 trillion in immediate debt. It's just a accounting trick. But what it does do, like I said, is it gives all these other countries the idea to go, ooh, this is a good idea. And it just increases even more demand. Back to your other point, Andy, about the Germans. Yeah, again, remember that was 2012, 2013, after all the fiascos. They said, we'd like our gold back. And they said, give us 7 years. And then when they did start getting it back, like I said, it was some coin melt bars that, that the U.S. keeps, West Point or whatever. And then bars that were like brand new Swiss. And they're like, well, these aren't the bars we deposited all those years ago. It's like, remember when, and there's records of this. You could ask Rick Rule about this happening. When Sprott Management came up with the PSLV and the PHYS, when they built the PSLV, they needed physical silver because that's what that thing owns. They needed to store it at the Bank of Canada. And they were told, we'll get it to you eventually. I mean, took months for them to get the silver. And by the time they were getting it, again, it was brand new, like 1,000-ounce bars that were minted like the week before. This is all part of that just-in-time delivery system that has held for 50 years, but is now obviously currently being stressed. This idea that metal's moving around the planet because of tariffs, that's just a red herring. That's gaslighting. There's so much more going on behind. And like I said, if the U.S. revalues gold at $20,000, I don't even pick your number. Maybe they wanted $30,000 just so they could say, well, 20% of the money supply is, has gold behind. I don't know if that's just an accounting trick. It doesn't mean the price that you and I buy and sell gold at immediately becomes 10,000 or 20,000 or 30,000. But what it does, it's a real eye opener for the rest of the world. And Andy, I'll give you one more thing too. Everybody says, well, they can't, if the price of gold suddenly goes higher, it'll cause this financial catastrophe because, again, you talk all the time about the banks that are net short and all this kind of stuff, and it would be trillions of dollars of losses. Oh, man, that ain't how it works. Remember the Hunt brothers? What they do, they just change the rules.
The recent surge in silver deliveries and vault inflows highlights the growing demand for physical metal, raising questions about supply dynamics and market positioning. Historical patterns suggest that such movements often precede major price shifts, so investors are closely monitoring silver's trajectory. Meanwhile, discussions surrounding asset revaluation and strategic reserve utilization continue to shape financial policies, hinting at potential changes in the broader economic landscape. As global markets navigate uncertainty, the role of precious metals in wealth preservation remains a critical topic of debate. Do you believe the increasing accumulation of silver signals a fundamental shift in market structure, or is it simply a short-term response to economic uncertainty? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.